Yes, sir.
Preparing to live stream the meeting.
Yeah, mine says that the meeting is being live streamed.
Huh. Status bar still running. What's yours say?
Mine says the meeting is being live streamed. Content this meeting is being sent to YouTube. That's what it says. And I'm going to click OK.
Hey, there we go. We're live. I see you on YouTube,
Hey,
Terry.
there you go. Good evening, everybody. My name is Terry Duke. I'm the managing director for Cross Country Mortgage. For those of you who don't know me, I am also known as the Wise Man, WHYSMAN. I work with mortgage companies, real estate companies, title companies across the United States. And the goal here tonight with everybody's meeting is to talk a little bit about what the life of a real escrow is all about. The Cross Country has got a loan right now for a couple of the people that are going that turned into quite a problem here at the end. Just a little problem here, a little problem there, life of an escrow. So I just was asked to kind of talk about all the things that go on. So for most people, a purchase contract sets aside 30 days from the time that the contract is signed until the time that somebody is going to actually close the transaction. And the idea here is during that period of time, there is a lot of work that's done. Some of it's in front of the borrower, some of it's in front of the real estate agent, some of it's in front of the escrow company or settlement company. However, there is a lot of work that gets done by each of these companies, including us as a mortgage company, behind the scenes. It takes cooperation to make sure it works. So I'm going to take you through this life of an escrow so you can understand really what's going on. So when a buyer decides that they want to buy somebody's house, they make a purchase offer, and that purchase offer says, I'm going to pay $500,000 for this particular property, and we will be able to close this escrow within 30 days. Okay, great. But all along that is this new contract that dictates all the terms. And that contract says, okay, by this certain date, the escrow company will do their part. This period of time, the buyer will do his part. By this point, the seller will do his part. Now, the only person that's doing checks and balances realistically is supposed to be the real estate agents, okay? The real estate agents are like attorneys. They're representing both the buyer and the seller. And it's pretty important that they know what dates are supposed to be done so they can prod each other to get it done. It's not the mortgage company's job to keep everybody in line. And it's certainly not an escrow's job to keep everybody in line, because escrow by law is supposed to be an impartial third party. So when you get an escrow company that starts making outbound phone calls to the mortgage company or to anything that doesn't have to do with the escrow, they're violating, it's kind of like the Hippocratic Oath with regards to escrow companies. They are not to do anything without direction from both buyer and seller or their representative agents. And the minute that they do, you already have a problem. So let's go through what happens. So the contract gets accepted, whatever the terms are, and they agree to it on a weekend. And Monday morning, this is what goes on. Hopefully, we as a mortgage company have been notified. Hopefully, the real estate agents have all their signed contracts, and that's really good. At that point, they're going to contact an escrow or settlement company and say, hey, we got a new escrow settlement contract on 123 80th Street, and we would like you to handle this transaction. And in most of the states that you guys work in, that settlement company is also the escrow company. They're not independent like they are in California. So at that particular point, they are going to take all that contract and they're going to set up a file for it. Now, we as a mortgage company have a little bit different set of responsibilities. Our responsibility at this point is, in order for us to start a loan, I have to have things from that escrow company. That escrow company has to disclose all their fees, the title fees, the escrow fees, the third party fees, everything that's non-mortgage related. Like we just discovered in this transaction, by the way, there was a propane fee, and you're going to have homeowners association transfer fees, and you're going to have recording fees. You're going to have all of these things that are involved with this escrow. But we as a mortgage company are required by law to have something from the escrow company that tells us what those things are going to be. And we have to have that before we can disclose and start the actual processing of a loan. So the minute we know that there's an escrow, we send out to the escrow company, please provide us with the escrow instructions, please provide us with an estimated settlement statement, including all third-party fees, because there are going to be things we don't know about. There's going to be, maybe there's a septic certification they need. Maybe there's a manufactured housing certification, a structural engineer suit, a roofing certification. Maybe they're transferring personal property. Maybe there was propane. Maybe there's a potable water survey. All of those things have to be disclosed to begin with. And we need to know that. The escrow company's responsibility is to provide us documentation on the actual escrow itself. They're to provide us with a preliminary title policy of insurance. They're supposed to provide us with a vesting amendment for the particular borrower, so we know how that borrower is taking ownership. They're supposed to be sending us what's called a closing protection letter, which proves to us that they in fact have the legal right to be a certified escrow company, whatever. They have to send us their business license. Last but not least, they have to send us a receipt for the money that came to escrow. So here's caveat number one. If you're a real estate agent listening to this, if you're a mortgage professional listening to this, you're a borrower listening to this. The biggest mistake at this particular point is don't write a personal check for the earnest money deposit. Secondarily, don't go get a cashier's check. Make sure that you get wiring instructions from this escrow company and you wire the earnest money deposit from your normal bank account with your name on it directly to the escrow company. Because if you don't, it is going to be an absolute nightmare later to deal with. Okay, that's the simplest thing. Okay, so now we get this all going. The escrow company provides us all this documentation. It's our job now to take this loan and start the processing, which means that we now have to disclose. So for us to disclose, we have to have a viable loan. That means we know your name, your address, your social security number, your date of birth. We know where you work, how long you've worked there, where you've lived, how long you've lived there. Do you own or do you rent? We have a credit report. We, by this point, should have tax returns and W-2s and paycheck stubs and driver's licenses and social security cards and everything that goes along with this. We should have a purchase contract. If you've ever been divorced, we should have a divorce papers. If you've ever had a bankruptcy, we should have all the bankruptcy papers. These are all required for you to be able to do a loan, okay? Now, at this particular point, we as a lender also have to start talking to you about interest rates, okay? Now, the bottom line here is interest rates fluctuate on a daily basis. So making sure that you qualify, cross-country mortgage does things a little bit differently. When we start a loan, we take the worst rate on the rate sheet to make sure you're going to be okay. Why do we do this? Because we don't want to get caught later if interest rates go up. Okay, well, great. Then the normal rate will be lower than what we quoted you. If rates go down, then you're in even a better position because you'll have a lower rate. You never have to worry about whether you're going to qualify. Secondarily, in that life of an escrow, we push very hard for our clients to provide us all their documentation up front. Why? Because if there's going to be a problem, I want to know about it before you ever put up any earnest money, before you ever get into a binding contract. Because if there's going to be a problem, we want to know it before you start. Oh, surprise, you have a federal tax lien. Oh, surprise, you got a $3,000 a month child support lien to a Kardashian. I don't know. But the key here is we want to know before we ever start. And that makes your purchase that much less stressful. The last thing you want to do is put yourself through the stress of buying a house, putting yourself into escrow, all with the idea of maybe I don't qualify hanging over your head. So that's what we're going to do. So initially what's going to happen is we as the mortgage company are going to issue a set of disclosures to you. And when I mean issue a set, we're not talking about 10 or 15 documents. You're going to get 84 documents that you're going to be required to electronically sign. Absolutely read through them if you feel the necessity to. Understand every single one of them is scrutinized and approved and reviewed by the federal government before it can go to you as a borrower and before we can complete our process. So once all that paperwork is signed by you and we have all we need from escrow, then we can order an appraisal. Until you as a borrower sign that documentation, we can't order an appraisal. We're required to disclose what the fees are going to be, what the interest rate's going to be, what your cost to move in is going to be, what the property address is before we order an appraisal. Interest rate's going to be 30%. You're going to pay for it for 90 years. Great. You accepted that? Fine. We're going to order the appraisal. Now, here comes the first whammy that most people aren't aware of. I don't get to choose the appraiser. Nobody does. after we had the mortgage meltdown from 2008 to 2012, a mortgage company is required to have a panel of appraisers. And they say, we have a property at 123 Any Street that's going to need an appraisal. Okay, here's the purchase contract. Here's the information about the buyer. At that particular point, the buyer has to pay for this appraisal. And it's an impartial third party. That appraiser, we won't even know who the appraiser is until the appraiser is done. That appraiser is going to accept this order. They're going to contact the listing agent for the seller. They're going to make arrangements to go review the property. It's the seller's and the seller's agent's responsibility to not only give them access to the basement or the under part of the house, give them access to the attic if there is an attic to the house, to the manufactured home, provide them the tags and the manufacturing information about when the manufactured home was done. And the reason you need to have all this for this appraiser is because if it's not there or the property's not really up to snuff, it's going to cost an additional $250 to have that appraiser go back out there. You don't want to have that to happen. So the listing agent should make sure the property's clean, access to everything, no doors are locked, access to the garage, access to the under portion of the house, a basement, access to the attic, all the toilets flush, all the electricity works, the sinks work, the stove, the oven, the air conditioning, the heating, everything works. No broken windows, no broken screens, no chipped and peeling paint. All this stuff is what an appraiser is looking for because he's going to give value or she is going to give valuation to this property. Okay, so now this is one of those hidden things. We ask escrow for their paperwork. We get the purchase contract. We get the earnest money deposit proof. We get the loan started. You as the borrower sign the disclosure paperwork. We order an appraisal. And over the next 10 days, we're sitting there, well, we'll see, because we don't know what's happening. We don't have any ability to know what's happening because it's going on behind the scenes. At the same time, the escrow company is taking all the paperwork that they got from the borrower and from the seller, and they are working on a preliminary title report. Now, the preliminary title report is pretty important. Okay, that preliminary title report is going to verify, does the seller have the legal right, the ownership paperwork like a pink slip on a car, to transfer the property to Mr. Buyer? There's nothing holding him back. And are there any liens, judgments, anything that has to be paid off, making sure the property's not in foreclosure, making sure the property's not in bankruptcy. And then the same thing goes to the buyer. Does the buyer have the legal right? Are they who they say they are? Do they not, they don't have any outstanding judgments or collections or anything that they owe the federal government in tax liens that would preclude them from owning the property. And then they're going to ensure, the title company is going to ensure the peaceful transfer of ownership from seller to buyer. Okay, but this is called research. The title company is doing that. It doesn't happen instantaneously. This process takes 3 to 5 days. That's why you have a preliminary title report, and then you have a final title report. So along this same point, we as the mortgage company are doing a bunch of other things behind the scenes. We are contacting your landlord, your previous mortgage company, all the jobs you've had in the last 2 years. We're contacting your bank, your savings, your checking, your retirement, your investment, to verify that the statements that you gave that told us that you have $1 million in the bank, you truly have $1 million in the bank. You told us you played center field for the Yankees and you play for the Yankees, great. We're verifying with the Steinbrenner company in New York that you do work for the Yankees. We are verifying that the bank statements show a deposit for the money that you're getting on your income. Additionally, we're verifying your social security number. We're verifying that you have the legal right. And 2 other whammies. We are also verifying that in all the paperwork that you gave us, those tax returns are legitimate. We are verifying through the federal government that the tax returns you gave us are legitimate. Okay, so those people that are self-employed, we have to verify they've been self-employed for 2 years. We got to verify that they're putting money into the bank account that would match whatever's going into their declaring on their tax returns. We have to do this, and it's not instantaneous. We ask the federal government. It's called, the borrower signed a 4506T. It's a form that they sign at the time that we do the initial disclosures. That form is sent off to the federal government, and 3 to 5 days later, it comes back. It matches, or please notify the borrower that there's something wrong with it. Sometimes that's fraud, which is not a really good thing. Very rarely, but occasionally it happens. But again, we're doing that behind the scenes. The borrower at this point has also had all their paperwork reviewed, and we're saying, we need an updated paycheck stub. We need an updated bank statement. Oh, your driver's license expired. We're going through all this documentation to make sure that what gets submitted to the mortgage, to our underwriter, is going to pass the muster. You know, to be honest, with our level of experience, there are times that we withhold documentation from an underwriter because it doesn't really meet the standards. We just had a loan that had a problem where the borrower had a bunch of money in a bank account. We had to document where it came from, and the bank was so small, they didn't have online banking. So we had to give specific instructions to that borrower exactly how to get that documentation from the bank that would meet the mustard and meet the underwriter's condition. So we take all that documentation, with everything that comes, the appraisal comes in, there's no problem, maybe there is, there isn't. We put all that information, the final title report and everything all together in a nice, neat little cover letter off to an underwriter who then reviews everything that we've asked them to review. Now, one caveat to this is the appraiser may come up with issues. There's chipping and peeling paint. There appears to be a family of homeless mice living in the basement of your house. There appears to be 3 dead bodies in the backyard. I don't know what they find, but the reality is it's going to require the seller to fix it. And so the underwriter is going to make comments on that. Some underwriters, if it's not a health and safety issue, will allow us to fix that between the time that the loan's approved and the time that the loan's funds. However, some underwriters will require that they fix that before they issue a loan document. We had a loan in Alabama that had problems where the appraiser was calling out repairs that were required to be done before they would issue the loan documents. Okay, it happens, the same thing. One caveat to all of this is contractually, everybody is gone along with this, that we have X closing date. I always caution everybody, when people get pregnant and they're going to have a baby, they have a due date. Okay, real estate is the same way. Everybody would like for it to happen on that particular day, but you know what? Sometimes it doesn't. Sometimes it's a little late. Sometimes it's a little early. Our benefit is everything we start, we're going to close. We have that kind of experience. So everything goes to that underwriter and they literally go through all that paperwork. Now, whether it was before or after the loan went to underwriting, the borrower has to start making a decision, along with our help, on what interest rate they decided that they wanted. Do they want to spend money and buy the interest rate lower? Do they want to not spend as much money and have the interest rate normal? It is their choice. But here's the whammy. Once they make that choice and we lock the loan, we send them a document, which is now called the initial closing disclosure. It's called a CD. Until that buyer signs, nothing other than approval, there's nothing more we can do. Once they do sign that, they can't sign loan documents for 3 to 4 days afterwards. And here's the biggest whammy of all, is the biggest mistake most people make. When you are signing electronic forms, if it's 2 people, husband and wife, 2 single people, mom and dad, whatever it is, if they choose to sign on different days, it creates a problem. If they choose to sign 3, 4 days apart, those set of disclosures are useless. We have to reissue in a new set and wait. So whenever you're signing electronic paperwork, try to sign it on the exact same day, or at the worst, the next day. You don't want to create a delay. The loan we're just closing had a delay because borrower A and borrower B didn't even come close to signing on the same day. The same thing goes with the closing disclosure. That CD should be signed on the same day by both borrowers. That will then indicate that 3 days later, assuming everything goes well, we'll be in a position to sign loan documents. Now, one of the benefits to working in the relationship that we currently work with, Once that loan gets approved, everything goes extremely fast. The underwriter may come back and say, I need an updated paycheck stub or an updated bank statement. I need clarification on, this deduction from a paycheck stub. I need clarification on this $4 million deposit in the bank. Okay, that's the underwriter's prerogative. They're being paid to make sure and scrutinize that loan to make sure it meets the guidelines, whether it's going to Fannie Mae or Freddie Mac or FHA or VA. Okay, they are making those decisions. The key here is that we have to quickly turn around and respond to that. So if we have a list that comes from the underwriter, some of that stuff may be needed from escrow. Some of that stuff may be needed from us. Some of that stuff may be needed from the borrower. Again, time is of the essence. If I ask for something or we ask for something, it's not it shouldn't be a 2 or 3 day turnaround. It should be a less than 24-hour turnaround. It's kind of like when you call somebody, you wouldn't like me to say, oh, I'll call you back in 3 days. You want to hear back from me pretty quickly. It's pretty important. Same thing goes with a loan. Once you got a loan in process, quick response is very, very important. And again, sometimes it's not, and it causes unwanted delays. So here is the other caveat to everything. When there are delays at the beginning of the loan, there's never a way to make up that time at the end. So if you lose 3 or 4 days at the beginning because there's some mess up or you're slow or something happens, those 4 days are gone. They're never coming back. So there's no margin for error at the end. And that's a very important thing to know. So then what happens here at the end is once the underwriter has looked at all the documentation and they feel comfortable that everything meets the guidelines, they issue something called a CTC or clear to close. At that point, it's going to go so fast it's going to make your head spin. We are going to issue loan documents, the final closing disclosure. We're going to communicate with that escrow settlement company. Everything is going to get negotiated to the point of to the penny. You are going to need $212,415.78. Please wire that to the escrow company, and then they're going to make arrangements for you to sign those loan documents. And we can get the clear to close today, and you could be signing loan documents and becoming a homeowner tomorrow. That's how quick this whole process works. So the key here is follow the directions. Okay, if you've ever been to Disneyland or you've ever been to a theme park, they have queue lines. You go back and forth, back and forth. Try walking in the opposite direction one of these days, and you'll know what it's like to try to buck the system. One of the things that I do for all of our clients is I verify all those numbers from the escrow and the mortgage company to make sure that everything is correct so that we know to the penny that it's accurate. And then I'm going to buff it a little bit. If I asked you for 200, if the forms say we need $202,512, I'm going to say, wire 203, let's be safe, because something could happen tomorrow. I've had loan documents actually burn in a fire. I had a notary on their way to sign loan documents at a borrower's house. It was a car accident. The documents spread all over the highway. Okay, I've had people die. The key here is that extra day could cost more money. That extra day could be a problem. It could be an extra two. Okay, so we want to make sure that money gets wired with enough so that there's no last minute. The last thing I want to do is tell you to bring, 210.3, and it turns out you need 210.5. So I'll ask for 211 just so we don't have any problems at the end. The key to a life of an escrow is to keep everything moving forward. You do not want to be the constipation to a loan. You don't want to be the constipation to an escrow. You don't want to be a constipation to a real estate agent. The real estate agent is going to have a bunch of things that you sign along the way. Release your loan contingency, release your appraisal contingency, release your inspection contingency, make sure that you've asked for all your repairs. The escrow company is asking for a confidential statement of identification. They're asked for signed escrow instructions. They're asking for you to sign the vesting amendment. They're asking for you to wire that initial earnest money deposit into escrow right away. We as the mortgage company have a ton of things that we need from you. Make sure you respond timely. There is nothing more important during an escrow than this escrow. This is not the time to move money around from different accounts. It's not the time to take a vacation. And definitely don't go out and buy anything. Do not go out and buy a new car for the garage, buy furniture, washer, dryer. Do not apply for any new credit You don't quit your job, none of that. This is pretty much boring central for the 30 days. Okay. That's it. You can buy furniture and cars and any decorations that you want after they give you the keys and the escrow closes. Don't do anything before that. So, as we've talked a little bit about, that is the life of an escrow. And it's a lot more complex than everybody wants to make it out. Our job is just try to make it as simple as we possibly can by getting as much documentation for you up front, by getting as much documentation from the escrow company almost immediately after the escrow opens, and by communicating with our underwriting and processing and loan funding staff to make sure everything goes smoothly. Okay. There's no substitute for experience. I mean, everybody in this company has experience, but my job as the managing director, I've got 44 years worth of experience, 15,000 transactions. I know what to ask for. I know what the people are going to need. I know how to massage loans through. Our goal is to make it so that it's as smooth as it possibly could be for the buyer, take as much stress off them as possible. Okay. And then I'll handle the escrow company. I'll handle the real estate agents so that the borrower is concentrating on getting ready to move, not if it's going to close. Oh my gosh, here's another problem. No, we're just going to make it as easy as we possibly can. So you guys have any questions about escrow and the life of an escrow?
No, that was great stuff, Terry. We appreciate it.
Okay, well, thank you all. We'll look forward to seeing you soon.
All right, that's a wrap.